Please welcome my panelists. I'll introduce them as they come on the stage. All right, we have Jim Norris here, Managing Director of Vanguard International, Ken O'Keefe, Managing Director, Head of ETFs at FTSE Russell, and Eric Wiegand, Head of Xtrackers ETF Strategy, Europe and Asia at the Deutsche Wertpapierspezialisten at DWS. If you guys could just do me, in 30 seconds, just sum up what your role is in the industry to kick it off, I think that would be easiest. And Jim, why don't you start?
Jim Norris from Vanguard. I oversee all of our non-US operations.
Eric Wiegand. I basically look at our sales strategy and sales management for Europe and Asia for our ETF business.
Ken O'Keefe, I'm the global head of ETFs at FTSE Russell. When you think of ETFs and indexes, we're obviously the index provider providing the indexes that support the ETFs or the ETFs track.
All right, Eric, I want to start with you. And we had a great speech up here from Tim Buckley to kick it off. And he was saying that ETFs are their preferred vehicle for index investing. Why do you think that is, if you agree with him? Why are ETFs the best way to do that?
It's a very good question, because we always get the question also from clients to say, why should I use an ETF versus, for example, an index fund? And I think the answer is very simple. What can an index fund do what an ETF can't? So an ETF, for example, provides secondary market liquidity, which an index fund does not. In terms of costs, you have seen that ETF costs have come down significantly over time as the market grows, which makes it more competitive also versus index funds. So I think over time, all the benefits that ETFs have outweigh the benefits that other vehicles have, for example, index funds. So I think over time, the market will move to ETFs. So I fully agree with that statement, that ETFs will be the weapon of choice for most investors, for most decisions when it comes to index investing.
How much, Jim, how important is the transparency issue that our last panel was talking about? I mean, we've heard the word retrocessions mentioned here a couple of times, kind of a dirty word, at least in the press. Fees are small, but still can come down further. How much progress do you think we made on that in Europe?
I'd say in Europe, the progress has been slower, certainly slower than in the US, where it's really happened quite rapidly and frankly without any regulation. Look, I think the transparency piece, I often hear people say when we're going into new markets that, look, investors, they don't really care about fees. They're not fee sensitive. And the reality is they don't know about the fees. That's the issue. It's not that they're not fee sensitive. They don't know that they're paying fees. So look, there are a lot of services that are provided by distributors, by advisors, by platforms, and people have a right to be paid for those services. It should just be clear that people are paying for those services. And that's where we think the transparency piece is really important. People should know what they're paying. It isn't about whether the services are valuable. They are valuable. Just, you should know.
Ken, let me bring you into this. From the perspective of someone who kind of puts the indexes together and creates the basis for this, first of all, how much ETF investment is done with your index versus other vehicles like index funds, mutual funds, et cetera?
So it's a great question. So there's $16.2 trillion benchmarked to FTSE Russell indexes. Of that, $3.5 trillion is passively managed, and roughly $600 billion of that $3.5 trillion is in ETFs.
And growing? I mean, I'm assuming it's growing, but what's the rate?
Certainly, very quick on passive investments in many vehicles, but ETFs, you see the fastest growth for sure.
And do you see the costs also as the least?
So for large pension plans, they can create quite a deal with a large asset manager. So for a passive fund, they'll be even lower than an ETF. So you don't see you'll see some big pension plans are actually starting to adopt ETFs. But by and large, they'll be using them sometimes for maybe a tactical allocation to, as they move out of an active asset manager, what am I going to do with the money that active manager used to manage? I'm going to put it into an ETF and park it there until I make my final investment decision. So big pension plans might have another way through passive vehicles to find a low-cost alternative. But for retail wealth investors, I mean, ETFs are really, really driving costs down.
I noticed, Tim, one of the things he said was rebalancing is key here. And to me, that sounds expensive, right? Because I'm still old enough to think in a commission-based world. But do you have ETFs that kind of get around those kind of expenses, Eric? I mean, I was thinking maybe there's an ETF that can rebalance itself.
I mean, you see multi-asset solutions also in the ETF wrapper already. We have one which is live almost 10 years now. I think, but that's a niche of the market, I think. And this goes back also to the panel earlier. Trading costs are coming down. That's happening, the same as wrapper fees are coming down. So I think the rebalancing costs for investors over time have also come down quite significantly. And a great example is the FTSE 100 products that are in the market. If you trade the equity, it costs you a stamp. If you trade the ETF, it doesn't. So that already has benefits, which makes rebalancing cheaper. And I think that will continue going forward. Costs will come down on all ends, and that's, I think, then also for investors who rebalance portfolio. And maybe coming back also to the pension investors, we just did a survey, and it's perfectly right. Most of them have used, let's say, mandate segregated accounts in the past. But that's also changing because rebalancing is easier done with ETFs. So the growth of ETFs in their portfolios is just starting to kick in now. So ETFs there provide a benefit as well to larger investors, and that's starting to happening in big time now.
So what kind of difference do you see? You manage outside U.S. operations for Vanguard. In the U.S., it's already quite a large industry and takes quite a big slice of the pie. And I was talking earlier about the growth in sort of volume. It's been amazing here in Europe. What about for retail investors? Do you see this making up a bigger and bigger part of their portfolio?
Yeah, I think it will. I mean, that, by the way, is the biggest difference between what's happening in the U.S. and what's happening in Europe or Asia, for that matter, where the buyers today are largely institutions. I will add, by the way, that the institutions, they, in a sense, care less about the expense ratio. They care more about the liquidity, the size of the ETF itself, spreads on the ETF, because often they're in and out reasonably quickly. But look, I'll just go back to what Tim described. The world is gradually moving to a fee-based model. And whether that happens directly through regulation, whether it happens through competition, whether it happens through more transparency requirements, that is the way the world's going to go. And our experience is that the more fee-based a market becomes, the faster the uptake is with ETFs in particular. Another challenge with individual investors is many of the platforms, the UK is a good example, many of the platforms actually don't handle ETFs. They don't have the technology to manage them. As that changes, you're going to see more investors, retail investors using ETFs as well. So it's coming.
How do you address that, Eric? I mean, the technology issue, especially being here in Germany, we know that nobody likes infrastructure investment. How do you convince or get around those technology problems?
I think we can help in the discussions with, for example, platforms. I think one of the things we did very early on when we started the business, we worked with some of the platforms to bring ETFs on. We helped them in how the workflow is basically, how ETF trading works. We also entered into partnerships to make it easier for clients to trade on platforms, to do savings plans, for example. And this has worked very well. If you look at savings plan numbers in Germany and Xtrackers, they compile it for the entire German market from direct banks. The growth is fantastic. You have more than 500,000 savings plans in Germany. It's growing very stable, 15% every year. And we think as platforms see this growth, they need to do something to don't lose the clients to these competitors. So I think they will invest in the infrastructure because they have no choice, because ultimately they will lose the client if they can't offer ETFs long term. And that goes back to the advice part. They have to be able to transact in ETFs to also offer advice services on this. So I think they have no choice but to invest in the infrastructure, or they will lose the client.
I think you're seeing that same phenomenon with active asset managers getting into the ETF business, right? And a lot of the new entrants coming into the ETF business are large active asset managers that are watching this growth happen and figuring out, how do I get into that disruptive technology, which is ETFs? They may not want to come in with standard market cap weighted products, but they'll look at a way to, if you will, get into that ETF technology.
Don't you see more and more active asset managers using ETFs? It seems like, I mean, especially with the breadth of the products. I don't know how many thousand ETFs there are now, but there are a lot and growing quickly. It seems like there's almost no reason to go for an individual stock unless you're super, bottoms up.
Right. Well, look, I think on the active side there, you have to go make a distinction between traditional, fundamental, active equity management. I don't actually think you're seeing much uptake. I think you're seeing more active managers moving into the factor space. And again, that makes sense because to the extent that active managers deliver alpha, a significant amount of that alpha actually comes from factor exposure, not actually from underlying stock selection. So to me, we are an active manager, we do offer those factor exposures, but you're going to see ETFs using factors are going to be a substitute, not for passive. I think they're going to be a substitute for active. And it still comes back to, if you're an active manager, you don't need to offer an ETF. You can cut the fee on your fund and you'll have better performance.
Although this gets into kind of one of the criticisms of ETFs and kind of the danger, especially in the hands of retail investors, factoring must worry you. I mean, Ken, does it concern you that people are using devices that they don't understand or that they can quickly get crushed by?
Well, that's why it's really important for retail investors to work with professionals, to work with a financial advisor, right? You want to build that very core portfolio, well diversified, and then if there's satellite opportunities to perhaps add to your portfolio, that's something you should be doing with your financial advisor.
One of the big issues is also liquidity. I mean, we just saw a story across the Bloomberg terminal yesterday where someone sold 320 million euros worth of emerging market local currency debt, which is a big amount for that market. And how do you, Ken, I wonder, when you're putting together an index, I mean, you can see these smaller indexes, these more niche products that really move markets and affect individual companies on the indexes. Do you tailor your indexes to avoid issues?
So we design the indexes with the ETF providers, right, to achieve their investment objectives. And part of the investment objective is how investable is the index, how investable is the constituents of those indexes. So the index is one of the key things of building a good index to be the basis of an ETF is making sure the components are liquid enough for that kind of volume.
But you see, I can't remember what it was, but earlier this year, or I think last spring, there were a couple of small oil producers that all of a sudden dropped in value, and it turned out that it was because this ETF for smaller oil producers had just gotten so big that it owned the limit of all of the assets that it possibly could, and as a result, they had to go out and double the index. Eric, you know what I'm talking about, I'm guessing.
Yeah, you see that sometimes, but these are kind of niche topics, and you saw similar topics in Japan with leverage products, where the impact, let's say, on daily trading was very big, but also those are isolated incidents. But I would like to go back to the earlier questions on factors and how investors, and if that's a problem for retail investors, and how investors are using them. And in Europe especially, what we are seeing is that ETFs are a tool, right? And factor ETFs, or whatever the, let's say, the underlying portfolio is also a tool. And it's a tool in this case for decision making for active managers. So the uptake there is actually by professionals. So traditional asset managers are using these tools to do more with less. And that's, I think, a big trend that will continue. And we see a lot of demand also from pension investors in that space, where we are saying, okay, how can we build quant-based, or let's say simple strategies which have a goal in mind into a passive portfolio? Mainly on the fixed income side now. It started off with equities years back. Now you have the factor ETFs. People are starting to use it. But now that's moving to fixed income, where you see more and more investors demanding, let's say, tools which don't give you beta, but which make use of the beta characteristics and have, let's say, a goal-seeking strategy on top. And one example we have, which is quite successful, is a yield-seeking strategy in the corporate space for euro corporates and dollar corporates. And the feedback from investors is phenomenal on these type of things. But those are professionals. A retail investor probably won't touch it. And the advisor, in most cases, probably won't touch it. Unless they work for a large bank, they have a network, and they have the, let's say, the infrastructure, the content infrastructure behind it to educate their advisors and their clients. That's a different story. But let's say the retail investor itself, they won't touch it.
So I think it is, though. I have to say, I think it is a risk in that look, the market, the ETF market today is in broad-based portfolios. And that's most of the market sits in very broad exposures. German market, U.S. market, British, UK. I do think that the narrower and more esoteric the products get, there is more risk. And it tarnishes the structure, where the issue isn't about the structure. The issue is the investment strategy. And I do think it is a concern when investment strategies that a retail investor actually couldn't buy, they just wouldn't have access to that strategy. The problem is now some of them, they will be able to buy them because they can buy it on and some of these strategies are going to, they're going to do very well and do very poorly. We know how retail investors act. They see a product, they see it has a really high return. They go, oh, that must be a really good product, I'm going to buy it. They don't know what they're buying. So I actually do think that as an industry, we do need to be careful about not letting the structure, the ETF structure, be diminished or tarnished in any way because of investment strategies that, look, they probably aren't actually appropriate.
Well, does regulation address that? I mean, because in a sense, you're saying non-accredited investors are allowed to buy, basically hedge fund strategies and trade them like stocks.
To get some controversy going, I would disagree, because investors, especially in Europe, they have gotten complex strategies being sold to them traditionally anyway. So in the active or discretionary format. So, but also, for example, through insurance wrappers, etc. So retail investors owning complex strategies through a fund wrapper is nothing new, I think. And there I agree with you. The ETF kind of gets confused, where the vehicle is confused with the portfolio structure, and it reflects poorly if something goes wrong on the ETF itself and not the portfolio structure. And there I would agree with you, and there we have to do education. It's the same with trading. When we talk about flash crashes, ETFs are always at the forefront because you see what's happening via the ETF, but the ETF is not the reason it's happening. So I think to distinguish between those things is very important. That's the education we have to do. And coming back to your question, I think regulators are addressing it because we can't just sell every strategy, even if it's an ETF wrapper, to retail investors. That's why we have to have professional websites. We have to have the proper compliance disclosure, all these things to make it harder for the client to actually find these types of strategies which are a little more complex.
I want to talk, since this is the future of ETFs, I want to talk a little bit about the kind of products that you guys are developing. And Ken, I want to start with you because you're developing kind of the underlying indexes against which these investors are benchmarked. As Jim says, obviously most of the ETFs out there are tracking big, broad indexes, and they're really plain vanilla. But you're also developing really specific, really niche indexes, right, for them, or more than you used to. How is that progressing? What kind of stuff are you developing, and what are the trends? Yeah,
so first, absolutely, it's true. In terms of where the bulk of the assets are in the ETF market is in the broad products, and that will continue to be true. You look at the growth of the ETF market, and that double-digit growth, a lot of it is in the good old broad products that everybody knows and uses in the core of their portfolio. But there are new entrants coming into the marketplace, or existing entrants that I have a specific investment outcome that I want to provide to my end investors, and a lot of times that is factor-based. So we'll work with the ETF provider, and they might want to provide something that provides a high dividend. Because, well, recently, yields are starting to come up in fixed income, but historically they've been low. And maybe I want something that's low volatility. So we have a very unique way of combining factors. It's a very, very simplistic mathematical, literally multiplication of the low value factor times the yield factor gives you high div, low vol. And so those types of products are actually very easy for a company like ours to design and build for ETF providers, and again, to benefit end investors.
Is it hard for you, by the way, I said I wouldn't talk about fragmentation, but a little bit. Eric, is it hard for you to develop new products when you have to, tailor them to all of the different regulatory environments around Europe? I mean, just thinking about the tax implications of dividend-paying ETFs is difficult.
Tax is always a challenge, but that's, let's say, of secondary concern mostly. I think for us, the challenge is still investors want more access to, let's say, smaller segments of the market. So you have the sector, the explosion in sector and factor products on the equity side, but the same is happening on the fixed income side, where investors want different maturities, different risk profiles. So the challenge there is for us as an ETF provider to find out, okay, where is enough demand that it's worthwhile launching a product? I think that's the major challenge. I think what's happening now, you see a lot of investors looking for features. So currency hedging is a strong feature that investors are looking for across the board in Europe, but also in other markets in Asia, where we need to develop solutions across, let's say, the bigger products, the beta products where most of the assets are. So adding these features to the products, I think, is something that's happening now. And getting access to more and more niche parts of the markets is continuous discussions we have, where we have to basically say, okay, if we find enough investors, we might try it, but we have to make sure a product is viable long term, which in many cases for, let's say, these niche strategies is still not the case. And ETFGI, I think, puts out these statistics on where are most of the assets, and if you look at the spread, it's very top heavy, right? And especially in Europe, because of the competition and the fragmentation, you have a lot of products in the tail which are very, very small, which for the investor, I think, offers choice, but also increases complexity. So it's always, you kind of have to find a good balance. Yeah.
Where do you, Jim, I mean, you're from Philadelphia, so for you, trading stocks or frozen concentrated orange juice futures is in your blood. Americans do that, right? But here in Europe, it's not such a stock culture. It's not really such an investment, an equity culture. How do you convince the European market to get invested and then to buy these products that are new to them?
Well, look, I would say that the irony of our company is we've built the business not selling people what they want. We're selling them what they should want. And if you're going to have that mindset, you're going to have a very long-term strategy. And so, when we offered the first index fund, back in the mid-'70s, I mean, we had basically no money for almost a decade. Nobody wanted an index fund back then. So look, I think we think of it as the basic tenets of investing. They haven't changed in 200 years, and they're not going to change in the next 200 years. We're going to do basic building blocks. There's a handful of factors that we have pretty high conviction in that will deliver long-term outperformance, but there's only a handful in our estimation, and you've got to be a long-term investor to derive that. I agree on the fixed income side. I think there's huge opportunity for growth in the fixed income space, particularly as central banks begin to unwind, yields rise. Investors are going to be looking for fixed income opportunities, and I think the ETF is a brilliant structure to get them exposure versus trying to buy individual bonds. I think the secondary liquidity on the fixed income side is going to be a huge benefit for individuals and investors more broadly. But if all of the money in ETFs is heading towards the tails, then we're not going to be a very big ETF provider, because that's just not how we think 99% of the investors need to build portfolios.
Ken, do you see a big difference between your business here in Europe and the business in the States?
So the business in the States is more equity oriented. About 80% of the 80% of the ETFs AUM in the States is equity versus maybe 16%. Here it's more 22% fixed income, so it's higher. And I think just building on what Jim was saying, and I do see there's going to be a lot of growth in fixed income. Fixed income as an asset class is much larger, is larger than equity. But when you look in the ETF space, globally, 16% of ETF AUM is in fixed income. So there's that interesting dichotomy that the asset class is actually larger, but in ETFs it's fixed income is smaller. over time, that is definitely going to change. And it's in part going to change just because it's been later to come to market, fixed income, in terms of ETFs. But investors will start to see that it's actually an easier way to invest in fixed income by using an ETF. Right? They actually just trade on an exchange as opposed to trying to find out which broker-dealer actually has this ETF and what's the price and so on and so on. It's going to be so much easier to just buy a basket that's broadly diversified on an exchange.
I mean, I have to say the Bloomberg terminal, of course, was invented to help bond traders. Of course, we focus so much on stock stories because it's just, I guess, an easier story to tell. Do you see further technological innovations helping this growth? I mean, I think about the investment culture in Europe as a very conservative and staid culture, right? But this new wave of millennials using this app and that app to put investments away or look at their budgets seems to offer so much opportunity.
Well, again, I think we would certainly agree. What's happening in that fintech space is it's small. I mean, you look at the number of robo-advisors. There's a huge number of them. It seems like every month there's a new one, but the AUM is very, very small. I do think, look, that part of the business is going to grow. I wish it would be that it would end up being the whole market is going to be dominated by sort of robo fintech advisors, because of course inside most of them is an ETF, so that would be great for the industry. I just don't think that's what's going to happen. I think they're going to have success. I think the real breakthrough is going to be when the traditional asset managers, traditional advisors, traditional distributors adopt those technologies, bring those technologies into their own processes, combine them with what humans do, some of the unique things that humans do in that process. I think actually that's when you're going to see the real breakthrough with technology in the industry.
But just thinking about millennials, their wrapper of choice is very clearly ETFs. Schwab did a survey across various age groups, baby boomers, millennials, Generation X, and so on and so on. By far, millennials are adopting ETFs.
Eric, what do you think about the investment culture here? I mean, how have you seen it change since you came into the ETF business?
It's a very good point that we have already a lot of robo-advisors. So again, they are on the front end. A lot of is happening also in Germany. And I fully agree the adoption, or when houses like us or Vanguard or BlackRock, the big asset managers, adopt these technologies for their advisors, I think this is when the big breakthrough will be happening. And it's already starting. So we are thinking a lot about digitizing the entire workflow from how we produce a product to how we sell it and how the client can access their portfolios and view the product. So for us, it's all going to be a digital experience at some point. So for us as a firm, that's a key driver of how we look at the business. And I think it's also a challenge in the sense that we have to find a balance between what do we offer to end investors directly and what do we do for our partners to not be in competition with our traditional clients, because that's not what we want. And I think that's a key thing for us as well when we look at these technologies. How do we use them? How do we market them? How can our network partners use them in their communication with their clients? I think that's key, and that's happening. And I think for growth for us, that's unavoidable and a necessity to invest in the digital infrastructure.
If you want to see the future, go to China. And if you want to see what the future of the industry is going to look like, go spend a week in Shanghai and Hangzhou and go visit Ant Financial and Tencent and Lufex, and this is where the industry is going. It's coming.
Maybe more fragmented in
Europe, much more fragmented.
But same technology.
Yeah. I just want to finally, it's great that you bring up China, because I wanted to ask what you thought about Marxism. If passive investing...
I need to turn my mic off for that.
is worse than Marxism. I mean, the concern, I think it was a Bernstein note a couple of years ago that I remember called that out. The concern, of course, is that if everyone's investing, if all these millennials are investing in ETFs, nobody is going to take a particular stand in a single company. And you can easily see how that concern would arise. How do you fix that issue?
Well, maybe there's two things in there. One is price, the whole issue of price discovery. And we always go back to, look, indexing is 15% of the global equity market today. It's small. And if you look at it on a trading basis, it's less, on the equity side, it's less than 5% of all the trading happening in the equity markets is index passive managers. So,
but you want to grow that percentage, right?
But again, because passive managers they're different types of investors, there is ample price discovery happening. I just don't see, we're so far away from being at some point where you'd say there might be an equilibrium tip. I guess, again, existentially, I guess that could happen. I just don't see that in the foreseeable future. But
there's always going to be active managers that are going to step in if they think something's, mispriced. There's high frequency traders. That's what they do all day, right? So I think there's mechanisms in the marketplace that would address that. And I agree with Jim. I mean, indexing is not that big at 15%. And when you look at how indexes are used throughout the investment process, it just makes sense then to use a passive product. I mean, it starts off when doing research and understanding, what is the risk-return profile of European equities versus Japanese equities versus U.S. equities. Well, you do that by looking at indexes. You want to do the same thing on fixed income, looking at investment grade versus high yield versus sovereigns. You do that we're using indexes. Once you understand the risk-return profile of those various asset classes, you then want to pull them together in your asset allocation decision, right? That's the most important decision that we all make, right? Where am I putting my money? Right? Once I've made that decision, it's so much easier then to say I'm going to then actually execute that asset allocation by using index-based products. Index-based products that are either using the same exact index I use in my research or darn close to it. It just makes that whole process so much easier for execution from research through to actually building your portfolio.
Fascinating stuff, guys. Unfortunately, we're out of time, but thanks so much for joining us. Really appreciate it.
Great. Thank you.
Thanks, Mark.